You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Monday. So I already told you last week the topic of today's podcast. Canadian Tire's came back strong this year. I do have 3 lessons for you at the end of this episode about this story. But today we're going to look at what's behind Canadian Tire's comeback. Because seriously, that was just kind of crazy. I noticed this because I have a very small position in Canadian Tire in my Smith Manover portfolio. So I am building slowly but surely a Smith Manover portfolio. Every month I'm using $500 instead of adding it into paying a capital of $500 on my mortgage. I would draw that $500 back, and then I invest in the stock market in a taxable account, so I can deduct the interest I'm paying on that small portion of my mortgage. And the goal is to create a portfolio that generates about 4% yield to at least compensate for a large part of the interest that I have to pay on the home equity line of credit. So Canadian Tire was a perfect fit. I bought it maybe a year and a half ago. Can't remember. Doesn't really matter. But what I realized is that for a long time, Canadian Tire was down. And at one point, it was even down by 25%, just the stock price, not counting the dividends. So maybe down 20% total return. Definitely not something to celebrate, right? And then I realized not so long ago that it's back in positive territories in my portfolio. Again, not counting the dividends. So I know I'm making a little bit more money. So I'm like, wow, what's going on here? And then I looked at the stock price graph. And in July of 23, the stock was trading around $188, went all the way down to $127 in April of 24. And now we're trading around 160. So big comeback between April and today. Still not trading at a all-time high. So what happened? Kind of ironic because over that time, the revenue were going down quarter after quarter. Earnings were hurt as well. And even the dividend growth slowed down. So as you know, I always look at the dividend triangle. So this one definitely did not have a strong dividend triangle over the past year, 2 years, right? The main narrative here is quite simple. Inflation and high interest rate has strapped consumers now for several quarters, and I reported that on the Moose several times. Pretty much each quarter, the CEO was coming up saying, you know what? Consumers are still buying basic stuff, like household stuff and just the essentials. But for all the extra, the discretionary expenses, it's just completely flat. There's nothing. And we saw that in the latest quarter. And this is where it's kind of ironic, right? If you look at the stock price graph, you will notice that in August of 2024, so literally 2 months ago, when Canadian Tire reported their latest quarterly earnings, the stock price started to go up, but a lot faster. So on earnings day, the stock jumped, and then it continued to go up and up and up. So let's take a look at the quarter, and then let's consider what has changed and what's the narrative while the stock price is going up now. So on August 8th, Canadian Tire reported actually a mixed quarter. So we saw revenue down 3%, and then earnings per share were up 16%. So that was the good thing. But then when you look a little bit deeper and you look at comparable sales, which is one of the most important metric when you look at retailers or restaurant chains, you want to know if the exact same restaurant, or in this case, the exact same Canadian Tire or Sport Chek store last year versus this year, if they are able to grow. Because it's one thing to grow by opening new stores, but if you're not able to grow organically, just attracting more customers to your existing stores, well, at one point you're going to saturate your market and it's going to be very hard to generate any growth. And then comparable growth sales were down 4.6%. So that's almost 5%. And again, same story. Discretionary spending are down. So we saw that in Canadian Tire. The same store sales were down 5.5%. In Sport Cheks and Marks as well was down, so 1.7 and 0.9%. So everybody is spending less. Actually, the only place where the company made more money, so growing revenue, was actually their financial service segment. So people get into more debts, and then Canadian Tire get like interest on those payments. We can see that as a positive. I'm laughing a little bit because it's not exactly positive thinking that your consumers are not able to pay their stuff on time and they have to pay interest on their Canadian Tire interest card. So not too convinced it's a good sign for the long run, but in the short term, at least it was a positive thing. Of course, the big highlight there was the earnings per share jump by 16%. That was mostly because of a focus on controlling their cost, improving their efficiency, and improving margins. Of course, when the market sees that the business is making more money, everybody smiles, but still, we cannot say that it was a big victory on this quarter, right? So what exactly changed? And before we move on to that question, I want you to invite you to the Retirement Rocks waitlist. I am working on building the #1 retirement online community in Canada. The place where you can ask your question, you can connect with other retirees, and find answers to all your questions. So we're gonna have like themes every month. We're gonna have like a structure with webinars and courses and more information. But the most important thing is you'll be able to meet people in the same situation as you, and you can help each other as you transition into your retirement phase. So for all people thinking about retirement or young retirees, like about 5 years in retirement, I'm sure you have plenty of questions. You can get into our wait list to get more information about that at moosemarkets.com/retirement. So that moosemarkets.com/retirement. All right, so back to Canadian Tire. So this is where the lessons are super important. #1 lesson, and I told you the 3 lessons. Right now we have 3 minutes. That's perfect. So #1 lesson, the market is always looking forward. So while as an investor, you may look at this quarter and think, well, there's no growth here. Yes, they're making more like earnings, but that cannot be sustainable unless they grow their revenue over the long run. So that's going to last for a few quarters. So what's the hype here? Well, the market is already super happy because Canadian Tire became more efficient, more profitable right now. So it means that whenever they will increase their revenue going forward, it's going to make a lot more money in their pockets. The second thing here is also, as they look forward, they see interest rate going down, and this is of course a very positive sign for Canadian Tire because it's going to give a little bit more wiggle room in consumers' budget. So there's a hope that revenue is going to go up. So that's lesson #1. The market is not looking at the numbers today, but they're looking at those numbers thinking about what's going to happen moving forward. Now, lesson #2. Canadian Tire is cyclical, so know what you own and why you own it. When you enter a position in a cyclical stock, expect the roller coaster. Don't be surprised to see a stock going down by 20%. This is normal. This is the market. I've discussed Canadian Natural Resources last week, CNQ, an amazing business. Great business model, vertically integrated, amazing assets, but it will follow the oil price barrel. It goes up, the stock goes up. It goes down, the stock goes down. That's how it's structured. Canadian Tire will follow consumers. Consumers are happy, they have a job, they have confidence in the economy, and they want to spend more. Canadian Tire is going to make more money. Canadians, consumers are afraid of the future. They're not too sure they're going to keep their job, so they rather pay off their debt and save money while they spend less. And Canadian Tire, the stock price goes down. So just be aware of what you have in your portfolio. It will alleviate a lot of stress. And then, speaking of stress, lesson #3, just stop looking at the stock price. I know it's crazy, but the stock price over a short period of time is completely irrelevant. So the market has a mood. There is demand for a stock or less demand for a stock. If there's less demand for a stock, the yield will goes up because nobody will want to buy that company. That's how high yield are being created. Now the key is it because the company is struggling and never going to come back? Or is it because the company is cyclical and we are into a tougher economic environment and this is why Canadian Tire is down? Well, my guess is that it's number two. I may be wrong, but I will go with the cyclical hypothesis here. So stop looking at the stock price over a short period of time. We'll just take the stress away. Instead of looking at the stock price, look at the fundamentals. Look to see if there's a direction, if there's an explanation in where the dividend triangle is going. Right now, the dividend triangle at Canadian Tire is not looking that great. Earnings per share are quite hectic and revenues are slowing down. And as I mentioned earlier, the dividend is also slowing down. So this one will be a higher risk play if you want to enter into a position than selecting a company like Dollarama where everything is up, revenue, earnings, and dividend. So just know what is the place, what is the role of that company in your portfolio. Since I focus for the Smith Maneuver on a little bit more risky plays, that is a perfect fit. But that doesn't mean that I'm going to make money out of it. Like far from it. It's just I'm saying I'm willing to take an additional level of risk when I invest in Canadian Tire for that reason. All right, Moose, I extended a little bit to 11 minutes, but I think it was worth it. If you enjoyed that podcast, please take 2 seconds, give me a 5-star rating on Apple Podcasts or on Spotify. And again, we're going to talk tomorrow morning. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.